Hi, this is Stuart Cooper with your mortgage market update for July 27th, 2022. And today we're going to talk about where interest rates are headed and my forecast over the next couple days and probably for the rest of the summer, because I'm starting to see things in a better light now based on some of the economic data that we're seeing. So real quickly, what I want to share with you is the Federal Reserve did raise interest rates today. The Fed's fund rate did go up 3/4 of a point. That was anticipated, so there was no real reaction. I mean, there was a reaction, but it was an anticipated event, so it wasn't like we were shocked or surprised by the Fed raising a rate. So anyway, that's definitely going to have an effect on the economy. The good news as far as interest rates are concerned is as the economy starts to slow down, it should really help interest rates, all right? So it's kind of an adverse reaction. So when the economy's doing really, really well, interest rates keep going up. When the economy starts to falter and starts to shift and starts to go down, we should see improved pricing. The big caveat, though, is the inflation. The inflation is so high right now that it's really messing everything up. So let's just talk about what's going to happen over the next couple of days, all right? So the Fed's fund rate went up 3/4 of a point. Like I said, it was anticipated. The stock market was actually rallying, a few minutes after that. It was up quite a few hundred points. But here's what I think is going to happen, and we'll know by tomorrow if I'm accurate or not. But I expect a sell-off in the stock market tomorrow because this euphoria of what just happened is going to sink in. And when people realize that the cost of borrowing money, the cost of buying anything has just gone up another 3/4 of a point on top of everything else, you're going to definitely have a contraction in the market. So I expect a big sell-off tomorrow. I also expect that there's a pretty good chance that we could have another sell-off on the bond market in the negative action and see rates increase because of just the volatility in the market. But the thing is doing this for as long as I have, you got to realize that sometimes you got to expect the volatility and not react to it so much. So that's kind of where I'm at right now. And then what we're going to do is I'm going to share with you some key data that I just looked at and why I'm starting to feel more comfortable with what the markets are doing and why they're going where they're going. And let's go ahead and jump into this. So let me just jump over to this website. And this website is actually, let's just look at it in a minute. It's the United States Census Bureau. And some of this information is a little bit older because they don't report it like minute to minute, but it's from June, July. So, but I just want to go over a couple key things with you. So, and this is when you're kind of doing forecasts, you got to look at everything that's going on around you to make informed decisions. So right now what we're seeing is right here, for example, advanced durable goods is up 1.9%. On the report, advanced retail inventories are going up, wholesale inventories are going up, and there's, and sometimes you got to look into that a little bit. Why is it going up? Well, for one, there's the supply chain issue is getting a little bit better, not a lot better. I mean, it's still pretty bad, but at least it's improving slightly. And I mean, I put an emphasis on slightly. And it also shows me that maybe the retail sales are not moving as quickly. That's why the inventories are starting to build up, is because they're not selling goods quick enough. And then some of the key information that I looked at is right here is new residential sales for June down 8.1%, and that's kind of to be expected. Higher interest rates, higher home values. People are starting to second guess if this is a good time to buy. And then new residential construction. Now this is a key thing that I always look at, and I always tell clients, if you're ever going to look at any indicator at all, look at what the builders are doing, because the builders typically spend more money on research, on analyzing market conditions before they build new projects. And if you think about it, it kind of makes sense. Because they're long-term construction. It's usually a few years out when they're building development. So they spend a lot of money on research, and they get it right more times than they get it wrong. So you really want to pay attention to the builders, what the builders are doing. When the builders start to back off, that's when you need to be worried about the housing market. All right. So we're down 2% for June, and May we're down 11.9%. So that's a huge indicator. All right, so you take that information and do what you want with it. But there was something down here I wanted to share with you, and this was amazing to me, and this kind of threw me off. Right, quarterly profits for retailers. First quarter 2022 down 21.3%. Let me say that again. Quarterly profits for retailers is down 21.3%. And what that's telling me is that they are taking it on the tail end on this inflation. Right now, we're all complaining about inflation because it sucks. There's no easy way around it. But the truth of the matter is the retailers are literally making less profit to try to not push the cost onto you. Because if you think about it, if you think inflation's bad right now, can you imagine if you added another 10% to the cost of any good? And that's basically what that's telling me, is that the retailers are taking it on because they know that if they raise the price as much as they have to, that they will not be able to sell the products. and that is not the sign of a strong economy. So let's go back and let's talk about mortgage-backed securities, and real quickly, what's coming out this week, because I always look at the economic calendars to kind of see what news is on the horizon that could affect interest rates. So we've already had the doozy for today, and that was the Fed's fund rate, which we all anticipated. The big thing that's coming out on Friday is this right here. This is personal consumption expenditures. That's basically an inflation indicator, and it's anticipated to be 4.7%. So that could, if it's higher than 4.7, that could be really bad news for mortgages. But if it's starting to come down a little bit, that'll be fantastic news. And you can also see right here the key levels for the 10-year yield. We're in the green, which means the market's not too volatile. But what I wanted to share with you this is. Oh wait, I'm sorry, I was looking at the wrong graph. I was looking at okay, sorry. I want to look at the 10-year Treasury, and I want to go back 6 months, and I'm going to point something out to you. So right here is the resistance levels that's set up. Now this resistance level set up back in April, beginning of April, and you can kind of see right here around April 12th, right? We bounced off of it here, we bounced off of it here, we bounced off it here, we bounced off it here, and we are bouncing it off it here right now. So that is the resistance level. So something's got to really be strong to get us below that to get rates down. So I think we're going to be stuck at this kind of rate for a while. And then we do have like this new trading range. I expect us to trade between 2.71 and about 3.2. So we're going to bounce around like in here for the next couple of weeks, probably most of the summer. So I think a lot of the volatility is gonna dissipate, so we're not going to see these huge rate increases, or we're not going to see these huge drops in interest rates. So I think for the foreseeable future, at least for the next month or so, we're kind of going to be holding steady where rates are currently at. So I hope you like this information. If you do, please subscribe to my channel. And of course, if you have any questions or comments, go ahead and put a comment on there, and I'll try to get back to you if I can answer it. And I hope you guys have a great week. Thank you.